Hello, amazing people. We've been asked, how do mortgage rates work? You may be wondering how mortgage rates are decided. Obviously, you want to make sure that you get the lowest rate possible. But how are mortgage rates determined? And what can you do to make sure you have a low rate? Excellent question. Hello, this is Sherif Oliver, the Lone Ranger. And today in this video, we will share how mortgage rates work. There are several outside factors that affect how mortgage rates are determined today, but you can only control one aspect of your mortgage rate, and that is your own personal factors. Now, lenders look at your qualifying factors to determine your risk. The better your qualifying factors, you guessed it, the better the interest rate they'll offer. Mortgage rates begin with the current market rates. So you may wonder how the market affects interest rates. Mortgage rates affected by the economy. See, now, mortgage rates are affected by the overall economy. So when the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. When the economy is doing well, borrowers can afford more. The Federal Reserve doesn't set mortgage rates, but it does affect mortgage rates indirectly. So the Fed controls short-term interest rates by increasing them or decreasing them based on the state of the economy. While mortgage rates aren't directly tied to the Fed rates, when the Fed rate changes, the prime rate for mortgages usually follows suit shortly afterward. So the Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, as it has been the case during COVID-19, the Fed lowers the rate. These are not the rates given to consumers. However, they are the rates at which banks can borrow money to lend to consumers. So when the Fed decides they need to tighten up the money supply, you know what they do? They raise the Fed rate. While that doesn't directly increase mortgage rates, eventually banks and lenders must follow suit just to keep up with their costs to borrow money from the Fed. So we all understand when they borrow money from the Fed, they pass it on to us, but have to get a margin to increase it. So which personal factors affect your mortgage rate? Good question. You certainly cannot control the economic factors of mortgage rates, but you can most definitely control your personal factors. Let's dive into what you can do to get the best mortgage rate possible, beginning with your credit score. A high credit score means, you guessed it, you're less of a risk to lenders. A high credit score shows that you pay your bills on time and don't overextend your credit. So when lenders pull your credit report, they see you are a responsible borrower with a low risk of default. This in turn leads to lenders to give you a better interest rate because you are less of a risk. When you have a low credit score, lenders often change the interest rate significantly because you're at a higher risk of default for the mortgage you are getting. A low credit score indicates that you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the loan program you're using. If you want conventional loan, you'll need at least a 620 credit score. But if you choose an FHA or government financing, you need around a 580 for most lenders. Some of us can go a little bit lower. Now, taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you can control is your down payment. Lenders want to know that you're invested. You have some skin in the game when it comes to putting down a down payment, that you aren't borrowing 100% of the funds. So the more money you have invested in the home, the less likely you are to default. That's how they think. That's their mindset. Now, if you put down less than 20% on a home, your mortgage rate will increase and you'll need to pay mortgage insurance. And to be honest, that's most of us. And there are different types of insurance depending on your loan program. And some are cancelable and some are not. So that means the more you pay down on the loan during the years, you can cancel the mortgage insurance. Besides the mortgage insurance, if you put down less than 20% on a home, you'll also have to pay a higher interest rate because you're at a higher risk of default with the lower down payment. And lenders make up for the risk by charging a little bit higher interest rate. The next thing that will affect your interest rate is your loan to value ratio. We in the industry call it LTV, loan to value ratio. A loan to value ratio compares the amount of a loan you're hoping to borrow against the appraised value of the property that you want to buy. The less money you put down on the home, the higher your LTV becomes, which is at a higher risk for the lender. Now, when you put little money on your own into the home, you'll have less incentive to keep paying the mortgage, is how they think. You'll have less incentive when times get tough. Now, if you have your own money invested, though, you're more likely to do what's necessary to make good on the debt. Now remember, this is how bankers think. Now, lenders charge higher interest rates when there's a higher risk, which means if you put more money down, you have more to lose. Another factor lenders will look at when raising your risk is how you intend to occupy the house. So let's talk about occupancy. Lenders care about whether your home is your primary residence, and that means that you'll be living there, or if the home is a second home, like a vacation property. And finally, if the home is an investment property that you will rent out to others. Interest rates are usually lowest on primary residences because it's simply where you live. So they believe you're more likely to make your payments on time because you don't want to be put out of your home, do you? You don't want to lose your home. So if you have a second home or an investment property and you have financial issues, you're more likely to default on the mortgage, putting the lender at risk. Most lenders charge higher mortgage rates to make up for the risk. The bottom line is simply this: both market and personal factors affect your mortgage rate. While you can't do anything about the market conditions, you can control your personal factors. That means improving your credit score. That means saving for a large down payment. Those are two ways, or the best ways, to improve your chances of securing the best mortgage rates. So guys, I want you to be sure to take care of what you can control when it comes to mortgage rates by looking closely at your personal factors and make them as good as possible to ensure you get the best interest rates available when applying for a mortgage. Always be sure to work with a licensed mortgage professional and get your question answers. Remember, this is your largest investment. There aren't any silly questions. This is a no judgment zone. So again, thanks for watching this video. I'm Sherif Oliver, the Lone Ranger. And if you or someone you know is looking to buy a home or just get questions answered, please do not hesitate to contact me at the website's on the bottom. I look forward to helping you get into the house of your dreams. Bye for now. Until next time.